Hello and welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining and exploration space. Joining me today is Nicole Adshead-Bell of Cupel Advisory. Nicole, welcome back to Kitco.
Paul, thank you very much for having me, and I'm looking forward to today's chat.
It's great to see you, and what a great week for us to be talking. We are in the midst of the June quarter reporting season, and what we are hearing a lot of from gold companies, we're hearing record free cash flow from Agnico Eagle Mines, from Kinross Gold, from Alamos Gold, and from Newmont Mining so far. The gold price averaged $3,280 per ounce in the quarter, $400 more than in the March quarter, and almost $1,000 more than a year ago. Nicole, the gold sector results have included exclamation marks as far as the eye can see. Are we in a bull market?
Absolutely. We're definitely in a bull market. We have rising commodity price. We're seeing the capital discipline that was enforced on these companies in the last bear market that still remains intact. And so you're getting true free cash flow generation. We're seeing lots of financings. I'm sure anyone that's watching this is some of the signs of being in a bull market as you see an increase in the volume of the financings. Those financings are closed very, very, very quickly. And in addition, they're generally upsized. So we're starting to see that behavior and interest move down towards the riskier, if you will, part of the sector in terms of the exploration side of things. And now I say we're in a bull market, but that doesn't mean that I think that it's going to end in the very near future. But we're definitely, I've got all the classic signs in terms of cycle positioning.
Excellent. And in addition to that, the financings, a lot of those are increasingly brokered, and we're seeing a lot of bought deal financing as well. So the brokerage houses, the banks seem to be very confident they can sell and place stock. AngloGold Ashanti ended the quarter with more than $2 billion in cash in its treasury, and it made the most aggressive dividend move by bumping its 12 per share quarterly dividend to 80 cents by paying half of the free cash flow it generated for the first 6 months of the year through to June 30. Nicole, pop quiz for you. How many companies that have reported so far have more than $1 billion of cash on their balance sheets?
I have no idea, but I would say probably the majority of them, because it's the larger companies that are reporting. And the question is, what are they going to do with that cash? And are we going to see the same behavior?
We'll get to that just in a moment, but okay, let's put you out your misery. 5, AngloGold Ashanti, Agnico Eagle Mines, Kinross Gold, Newmont, and Eldorado Gold. Newmont finished the quarter with $6.2 billion in cash. It maintained its 25 per share dividend. It announced a new $3 billion share buyback program and a tender to buy back $2 billion of debt. A great quarter for the gold sector. What are your thoughts on its use of its growing cash pile?
I think what generally happens in this kind of environment is you're seeing the low risk behavior, which is buying back shares, which is saying that you think you're very undervalued and obviously increasing appetite for your shares. So theoretically increasing the talk in the share price. Number one. Number two, increasing dividends. Obviously that's showing, but the issue with dividends is you need to show stable dividends, and we live in a volatile gold price environment. I think the next thing that we'll start to see, and we've already seen it, is this continued focus on M&A. When we're in this part of the cycle and as it matures, generally investors start to want to see growth. They want to see investment in increasing the production base, increasing the resource base, and then you start seeing more and more aggressive M&A type behavior. And we've already seen that over the last 18 months.
Now, let me push back on you a little bit there, Nicole, if I may. I understand the logic and the reason for having a stable dividend, but surely investors invest in gold companies because they want exposure to the gold price, and that being the case, surely they would be okay with variable dividends or dividends that go up and down depending on the fortunes and the fluctuations of the gold price.
That's a tough one. I think that at the end of the day, investors own gold companies not just for dividends. There's a lot of volatility in underlying price. There's a lot of volatility in the sector, and really why you own those companies is for exposure to the times that we're experiencing now, where you have a massive increase in the underlying commodity price and you start to see that being reflected through the business. So we've seen these themes of behavior with approach to dividends, whether it's a gold-linked dividend, whether it's a royalty-like structure, whether it's fixed dividends. I think it's easy to calculate if it's fixed, and that's why you do see many companies have fixed dividends. So I don't know that there's a single approach that every investor wants to see or that every company approaches, but I think you're seeing a move towards, as boards of and management teams are looking at their dividend strategy, it's we've come out of this time of depressed prices and weak balance sheets, and so that kind of fear, if you will, is still part of the strategic discussion. So it's ensuring, can we pay dividends that are sustainable? And nobody likes to decrease their dividends. So I think you'll see some flux in that strategy. It just depends on how much longer that we are in this very strong gold price environment. And I would argue that gold should do well over the next 3 years as Trump remains president of the US.
Well, fair enough. And there's indications that US Federal Reserve Chairman Jerome Powell will cut. It's increasingly likely that he's going to cut interest rates in, I think it's the September meeting. Interesting what AngloGold Ashanti has done, sharing some of its free cash flow or more of its free cash flow generation with shareholders via a bonus dividend. Do you expect to see more companies issue sort of bonus dividends?
Yeah, absolutely. I mean, I think an interesting idea in Baker Steel, an Australian UK-based fund management group, are really pushing this in the bear market, which was dividends that did have a royalty-like structure, that were linked, that were assessed at the top line. And their argument was that mining companies pay royalties no matter where you are in the cycle. They're forced to do that. And so we'd like to start seeing that discipline in terms of being focused on the owners of your business, which are shareholders. And so I think you'll start to see special dividends. I think you'll continue to see share buybacks, but I think you'll also see a continued part of that capital allocation strategical approach in the mix. It is growth. It has to be. It's not just growth. It's also, how do we maintain our existing production profile? We live in a world where you're constantly depleting your assets. There has been very, very limited, I would say, globally, exploration dollars that have been spent in the ground, and a somewhat of a paucity of new discoveries. And the majors are trying to largely, I think, outsource their exploration business to the juniors. And I think that long term is impossible, because as a junior, if you don't have near-term exploration positive drill results, you will cease to exist. Nobody wants to find your business. And you might be doing the best strategic, thoughtful exploration, but if you don't have near-term results, then the market doesn't want to finance you. So I think we're going to start seeing more money spent on exploration. We're seeing an uptick in M&A. We're seeing M&A, as you and I have discussed on numerous occasions over the last 2 years, we're seeing M&A go from like with like and producers and focused on single asset producers. It's now moving into developers, and we're starting to see M&A in the exploration space as well.
Yeah, I agree with a lot of what you say there, Nicole. And with the share buybacks, we're already seeing companies increasing their share buybacks. So this year is going to blow out of the water last year's share buyback amounts, which totaled more than $7 billion. We're well on track to blow that out of the park. Newmont, which is now once again the most valuable gold company in the space, it surprised to the upside with net earnings of $2.1 billion. The company improved its all-in sustaining cost margin to about 44%, despite a 7% quarter-on-quarter and 33% year-on-year fall in production. Agnico Eagle Mines paid down debt and is now debt positive, or debt-free, net debt-free, and it had an all-in sustaining cost margin of more than 60%. That is almost $2,000 per ounce. Nicole, a great quarter for Newmont, but let's not get carried away with ourselves. This is digging deep after all. Newmont's performance has been mediocre for a few years now, firmly in the middle of the performance curve, despite being the industry leader, the sector leader. Were we only excited about Newmont because it was the first gold company to report earnings this quarter?
I think we're going to be excited about every gold producer, because most of them will be generating true free cash, and let's face it, that's a rarity in our business. No, Newmont strategically, obviously, there's been a lot of M&A over the last 3 to 4 years. They've had to digest that M&A, and then they've gone through a fairly aggressive sales price in terms of focusing their core business on their highest, their largest, their flagship tier one assets, if you will, and they've been divesting themselves of some of the smaller assets. And so I think what you see when that happens is it allows the business to start to focus its attention on those assets that are meaningful and material to it. And so I think that focus is a positive. I think the rising gold price, let's face it, rising tide floats all boats. And if you're not generating free cash flow in this current environment, you're doing something very, very, very wrong.
Now, if Newmont can really excite the market with its middle of the road performance, what are the expectations when some of the better performance, and I'm thinking companies like Lundin Gold, for example, when they report their quarter results?
I think what you'll see is why Newmont is a bit of a leading arbitrator of what's going to go on in the gold sector is if you're a generalist and you wake up and you go, oh, this thing called gold, I thought it was, we had the normal articles of the death of gold and the bear market, and suddenly you have this sector that is performing incredibly well and showing the talk when you have movements in the underlying commodity price environment. And so what does a generalist do? A large generalist, there's only very few companies that they can own, and it's the Newmonts of this world. And so you start to see generalist money trickle in, and then I think that interest starts to percolate down into the more talky sector of the business. And so for those of us that are in the sector and both love it and hate it at times, we're all very, very excited by what's happening, but we do need to see that marginal interest, and what it will drive that marginal interest is people are going to start to look at the incredible margins that we're seeing. And I'm saying margin and marginal quite a lot right now, but I think that will start to reinvigorate the generalist demand and a more broader retail following as well.
Now, the mining sector is much broader than just gold production. Whilst there's good times for gold companies, the diversifieds are having a hard time. Rio Tinto reported its lowest profits in 5 years, driven down by iron ore prices, while Glencore plans a $1 billion in cost cuts as its results were hit by falling coal prices. Nicole, why are bulk commodities suffering? Is this related to US tariffs?
Yes, I think it's what's going on globally. The US tariffs have provided a material layer of uncertainty as to what's going to happen globally, and markets don't do well, or investment themes don't do well in times of uncertainty. There's question marks about China and its building boom. You've got this general ESG thematic that's still playing out. You've got global investment that's kind of halted. You have an increase in supply and inventories of some of the bulks, and all of those things are contributing in terms of a weaker price and a weaker outlook. And what I think is really interesting is 3 years ago, every gold company was desperately trying to demonstrate that it had some non-gold-like thematic, so it could market itself as being available to those investors that were interested in critical minerals, and hence Barrick. I think focus on wanting to say that it would like to be and I say this a lot, but it would like to be a copper company when it grows up. And so I think what you're seeing is this global theme play out. Having said that, and I say this every time I talk about copper, I think what's unique about copper is that's also very much a supply side story, where at the bulks you probably have a bit of an oversupply situation combined with global uncertainty.
Fair enough. Let's get back to the precious metals. You mentioned M&A should be picking up, and indeed it is. Torex Gold Resources is buying Mexico precious metals developer Prime Mining in a $327 million deal with an 18.4% premium to get the Los Reyes Gold Silver project in Sinaloa that hosts 2.2 million ounces of indicated gold equivalent. The company recently completed its Media Luna development and is rapidly building a development pipeline. In June, it moved to buy Reyna Silver for $26 million to obtain early stage exploration projects in Chihuahua in northern Mexico. Nicole, a clear statement of intent here by Torex that it plans to grow and leverage its mine building expertise in Mexico and diversify away from being a single asset producer. What are your thoughts on its strategy?
I expect that Torex was looking at producing assets. I think that there's a huge amount of demand and interest in acquiring production, whether it's from the Newmont asset sale or whether it's from single asset producers. But that environment has been incredibly competitive. And so I think what Torex has probably done, and which is very, very rational, is step back and go, well, there's a lot less interest and competition in the developer and the advanced developer space. And at the end of the day, M&A is hard to do at the best of times, and that's normally due to social issues. That is, who's going to run the company post the M&A event, and frankly speaking, it's often the less good CEO, if you will, that is insisting that the deal will only move forward if they're going to run Newco. And so I think what Torex has done is shown a commitment to Mexico. Obviously, it knows how to work within the company. It has acquired a development asset, so it is diversified its risk, and it's shown a commitment to exploration by acquiring an exploration asset. And so I actually think that smart money should be looking at the developer space, because we're starting to see that trickle down effect. Lots of competition, high high price deals for assets and single asset companies and the smaller producers. And then it's what can we do to start to cement our growth pipeline? And that's when you start to see the trickle down effect into the developer space. And I think what Torex has done is a very rational strategy and a defendable strategy. And I think they're an early mover in that space. And I would also say that the best defense, if you're looking as in this world of M&A, which is going to heat up, the best defense is a strong offense. It's something I probably embrace a little too well in my own life, but I think they're also understanding that if you're not growing and expanding and acquiring, then you're likely to be acquired yourself.
Absolutely. I was going to touch on that there's the defensive aspect to this. Torex produces 400,000, 500,000 ounces a year. It generates good margin. It generates a lot of cash flow. So being a single asset producer perhaps leaves it hostile to vulnerable to a hostile bid. And also having that cash flow means it's got the time to develop a new project or advanced exploration projects. It doesn't necessarily have the same time pressure on it. So it's able to really bring that into its fold and do the work necessary to develop a second mine.
Well, you mentioned hostile bids. It's something that is actually very, very rare in our sector, and there's always this fear of it, but it's hard to transact hostilely. What I will say is if a company comes in and offers above precedent transaction premium to its target, and so if you look at the average precedent transaction premiums over the last 30 years, it's been around 30%. If someone comes in and offers higher than that, boards and management teams have to take that very, very, very seriously, because I think you put yourself in a position of risk with respect to future class action lawsuits if you don't take that to your shareholders. And so as we start to see this behaviour and more competition in the M&A side, that's when you start to see also an increase in the premiums that are paid, because you offer a higher than present average transaction premium. The company almost has to make that public. So it'll be interesting to see what happens with the premium expansion with corporate M&A over the next 18 months.
Absolutely. A lot of people looking for that to go much higher. Now, Franco-Nevada, the leading company in the royalty streaming space, they acquired a 1% NSR net smelter returns royalty on AngloGold Ashanti's Arthur Gold project in Nevada from Alamos Minerals for $250 million and a possible contingent payment of $25 million. This is hot on the heels of Triple Flag buying Origin royalties for $305 million to get a 1% NSR on Arthur, the same project. Nicole, it seems the big guys in the royalty space are moving in on Arthur. Does this royalty action suggest that Arthur is perhaps going to be something exceptional?
I think it already is something exceptional at 16 million ounces, approximately combined M&I and inferred. And I need to say that I'm somewhat conflicted. I am a director of Altius, and so you could argue being biased, but our geological team within the company, led by VP of Exploration, Dr. Lawrence Winters, we spent a lot of time trying to understand what this asset is worth and the potential exploration upside. And this is one of those rare, true, tier one, long-lived assets that's got massive potential for further upside. And if someone wants to dig into our view, and obviously we have a very positive view, but I would recommend going to Altius' website and looking at their most recent corporate presentation. So it does a very, very good job of outlining the geological case as to what this means. And look, it's in a politically safe jurisdiction. It is the gift that keeps on giving in terms of resource expansion. It is a fantastic deposit. Almost every company says they have a tier one asset. Obviously that's theoretically impossible. They're very, very few and far between, and this is one of them.
Excellent. Well, great news there for all of those companies involved. I think a lot of people are very interested to hear from AngloGold Ashanti what its development plan is. Anglo has been very, very sort of tight-lipped over the years that it's been exploring the silicon deposit and doing its acquisition. It's been very tight-lipped about what its plans are. I imagine you're very keen on getting more detail on that as well, Nicole.
That's true, but if you've spent a lot of time sifting through public information, whether it's on reports or presentations that the company has given, you can get a more holistic, I think, picture of probably what they're thinking about. And that's what we did at, I won't take credit for it, that's what the team did at Altius. And so I agree, everybody wants to see what this looks like, but they've got almost a golden problem, no pun intended, to have is is as you start that permitting process, you need to have an understanding, a very good understanding of how big this asset base is, because otherwise it could impinge and potentially condemn some areas of strong mineralisation. And so I think part of that lack of information is it's also, where does this deposit end? And so I think that's it's a nice problem to have as well.
Definitely. Also doing M&A this week is McEwen Inc. No longer McEwen Mining. They renamed as McEwen Inc. They agreed to acquire Canadian Gold with a 15% premium in a transaction valued at about 72.5 million Canadian dollars. They will obtain the Tartan mine in Manitoba in Canada, which McEwen believes is a similar opportunity to its Fox mine in Ontario. McEwen was already a key shareholder in Canadian Gold. Nicole, good to see McEwen in growth mode again after some very, very tough years.
Absolutely, and it's a great company to watch in some ways because Rob McEwen, obviously, the founder and for which the company is named, has really put his money where his mouth is. Had an incredible success with Goldcorp and has taken a very, very long-term view and is active in the sector. And so again, as we continue around this thematic of where you are in the cycle can be very, very predictive in terms of how it impacts or affects both investor and corporate behavior. And so this growth mode just means that companies and investors are starting to feel more comfortable about a sustained commodity price environment and strengthened balance sheets. And Rob is on the acquisition path again.
I think one interesting aspect of this, McEwen Mining is the main shareholder of McEwen Copper with the Los Azules project in San Juan in Argentina, which is still private. So its share price and market capitalization gets a good bump because of that. And to what extent or not do you think McEwen is able to leverage that to do transactions such as this? At some point, the company does say it's going to spin out McEwen Copper, which would leave a big hole in its balance sheet, so to speak. Is Rob McEwen making hay while the sun shines?
Oh, absolutely. I think he did a very good job in terms of managing the strategy around the copper side of the business. Obviously, I would say that McEwen has been a very strong advocate of gold, and it's taken and lived through numerous cycles. So I would say sees there's a lot of opportunities here. And at the end of the day, the job isn't as a material shareholder in his own business is also how do you create long-term value for your shareholders, and how do you, at the end of the day, generate that interest and value in your share price. It's all very well and good to say, well, we're worth this, but if the market doesn't agree, obviously there's a massive disconnect. And so I think that what the market would look at this and go, this is someone who's also very, very supportive of the businesses that he is intimately involved in terms of being willing to deploy capital in times of hardship.
Okay, McEwen, tartan. Let's continue the Scottish theme. Did you know that there's actually a McEwen tartan, which is blue and green, although that is spelled MACEWAN? Nicole, Vancouver exploration entrepreneurs are very quick to jump on the bandwagon of positive opportunities when they see a trend emerging. So how long do you think it will be before we see a company rename itself as Kilt Resources or Nessie Gold or Haggis Exploration or something like that, looking for more of Rob McEwen's money?
Probably not that long. And as they say, imitation is the most sincere form of flattery. And you're exactly right. Yeah, closeology, jumping on the bandwagon. It's something the Vancouver junior sector does incredibly well.
Okay, let's move on. Barrick Mining will increase its equity stake in copper silver explorer Hercule Metals under a strategic option agreement that will allow the junior to undertake district scale exploration over an additional 74,000 acres of unpatented mining claims surrounding the Leviathan property discovery in Idaho in the United States. After Barrick invested in Hercules in 2023, it also amassed a land position around it, which it is now handing over in this deal. Through that, Barrick can increase its ownership to 19.9% in the junior, and it also gets a 1% NSR. Nicole, what's your take on this? Barrick prides itself on its exploration ability. Idaho's not too far away from Nevada, where Barrick operates the Nevada gold mines and is having great exploration success. So why is Barrick, taking initial steps towards a potential exit here? Why wouldn't it want to continue exploring the ground with its team?
Paul, who knows? I struggle sometimes with Barrick's overall strategy. I think they invested arguably at the wrong time. Great for Hercules, had an awesome job of managing that financing before those drill results came out, and there was a lot of expectation that that initial drilling success would then materialize into something material quickly. As we know, the geological gods, sometimes it takes a long time. And so I think it's just probably moved down in its list of priorities. And it could be something as simple as whoever was the advocate of that particular investment in that project is no longer involved or has moved on to something else. So I wouldn't read too much into it. I think that Mark Bristow has been sort of very, very clear on what the long-term strategic goals with the name change, with Reko Diq and the focus on that. And then obviously, as you said, they've had great exploration success in Nevada. So, and he, I think strategically also tied himself into a little bit of a trap because making very, very public comments that you weren't ever going to pay a premium. And I think that Barrick's behaviour around Great Bear was a little different. I would argue they were probably working towards wanting to acquire Great Bear, hence the acquisition of projects that were contiguous with Great Bear. But in doing so, they ironically, because that was public, they drove up Great Bear's share price. If you go back and look at that transaction, its share price was moving up without gold price movement. It was moving up relative to the GDX and the GDXJ, and with no alpha events in terms of drilling. And so it was rumours of Barrick wanting to buy that company that drove that share price, which ultimately Kinross got. So who knows?
I think that's a great observation about Great Bear Resources. Apparently, Barrick entered the data room and did several due diligence visits to Great Bear and the Dixie project, and it did option agreements with, I think, 2 juniors that had land either end or surrounding Dixie. Obviously, Barrick never went on to buy that. As you mentioned, Kinross Gold picked that up. Is this a case of Baco, the mining version of Taco?
Potentially. And it's also companies, sometimes I think, you can't always expect companies to be rational. Sometimes you don't really know why they make the decisions that they do. And often, particularly on M&A, it surprised me when I was working as a banker at Hayward, is there wasn't necessarily a long-term strategic approach with many companies. It was just someone with influence going, I want to own this and I want to own this today, make it happen. And so you never really know what goes on the inside of a company. So yeah, it's going to be interesting to see what Barrick does.
Okay, well, let's go a little bit further into Bizarro World with news from Marathon Fusion, which said its tokamak fusion reactor technology can turn mercury into gold as a byproduct of fusion operations. The company claims it could create 5 tons of gold from mercury for every gigawatt of electricity generated. Nicole, my understanding is that gold is created in deep space in supernovas. What are your thoughts on this?
If that's true, sell all of your gold and your gold stocks right now. It's a wonderful sci-fi story, and investors love this. I mean, they've had media attention that the average small company that's the equivalent in our sector would dream of. They've been written up in the FT, in the Wall Street Journal. So I would say that people need to understand that we don't have, obviously there's been a lot of work towards fusion, and we've had moments of fusion reactors, but no sustainable fusion power generation, and that's the basis of their whole thesis. They have a paper, if anyone's interested, called Scalable Chrysopia via End-to-End Reactions Driven by Deuterium Tritium fusion neutrons. I'm reading that out. I went and read it, and it's kind of hilarious. The science actually checks out on paper, but if you don't have the fusion reactors, it's not going to exist. And so I would say this would be an example of nuclear alchemy meeting a great PowerPoint optimism and presentation. It's got great marketable side of things, but it's probably more sci-fi than anything else. And perhaps a good description is Lord of Pipe Dreams rather than Lord of the Rings. But great story. If we get eyes on gold, I'm an advocate of people out there selling the dream, so to speak.
Fair enough. Chrysopia is the posh word for alchemy. Taking on board your comments about this getting widespread publicity, this story is actually brought to my attention by my mother, who read it somewhere, which is, given that, Nicole, is this perhaps a signal, with stories like this coming out, is this perhaps a signal of a bull top for gold?
No, I don't think we're anywhere near a bull top for gold. We need a lot more generalist interest. And for me, the signs at the top, there's definitely some signs. So when you go on site visits, I just was in the Yukon and visited a number of projects. And I give a presentation about this as your swag the things that you get on a site visit can dictate where you are within the cycle. And in a bear market, you get a pen. And in a crazy bull market, you get Helly Hansen jackets and you get mugs with your own name and you get binoculars. So definitely the swag is improving. We're getting signals. We're absolutely in a bull market, but it's not toppy. For me, it's top of the market when moose pasture in the middle of nowhere has $100 million valuations. It's when all the generalists have come in, where M&A goes crazy, where people are overpaying for basically crap assets. That's the sell signal. And possibly the sell signal is when your taxi or Uber driver starts talking to you about gold stocks. That's when all the money is in, and that's time to exit. We're not there yet.
Okay, well, I'm off on site visits to Yukon next week, so you've just raised my expectations there. But let's double down on the bizarro. Mariana Minerals, which raised $85 million US from Silicon Valley's elite, according to the company. And it did that by not even telling them what its projects are, only giving them elusive names like Stealth 1 and Stealth 2. The company says that just as Tesla reimagined the automotive industry and SpaceX space exploration, Mariana said it is bringing minerals production into the 21st century with a software-first approach based on its Mariana OS digital nervous system that it said will compress project timelines from discovery to steady-state operations. Reading Mariana's materials, it is giving the impression that the world's top miners are sitting around and cosplaying as 49ers in terms of their approach to mining's challenges. Nicole, bold, mysterious and promising, or disruption, or just all mouth and no trousers?
I think that this is something I talk about a lot. We as an industry do an incredibly poor job of marketing ourselves and marketing ourselves to a wide range of the public. And I think what Mariana understands, and if you go and look at their website, the leadership is looking at the photographs, probably a bunch of millennials. And so they viscerally understand how to market and use it's all buzzwords. And I think why they've been successful in this is the average investor in Silicon Valley has no idea what mining is, has no idea that all the things they talk about are already embedded into everybody's structure and processes. They just package up the mining industry in a way that's sexy and exciting and palatable. And frankly speaking, I think that we could learn from that. So are they doing anything different? Absolutely not. Are they marketing it incredibly well? Absolutely yes. And that's proof with a very, very basic website, not a lot of information, and have raised a material amount of money that legitimate exploration companies, for example, would dream of getting their hands on. And so my advice is to everybody to look at what they're doing and how they're marketing and selling themselves and take notice and perhaps adapt some of that strategy for themselves.
Your comments, Nicole, remind me of another company I spoke with recently, which was called, I think, AdCap Resources, AdCap Minerals, something like that, AdCap Exploration, I can't remember exactly. Very young people on the C-suite, nothing wrong with that. 10% of their market capitalization they're spending on marketing, and they're spending an equal amount of marketing and promotion as they are on exploration, which I guess puts a lot of, let's say, traditional rule of thumb metrics in the industry on its head. What's your view on companies having such an aggressive marketing spend?
I think investors have to understand that they're going to be really good at mining the market, not necessarily about creating long-term value at the asset level, but we've got to realize as investors in this sector that there are two very different things between share price performance and asset quality. And so you might have the best project in the world and be doing a fantastic job, but have an inability to be able to message that in a way that resonates on the other side of the table. And the problem with our sector is there's just simply too many companies. You have over 3,000 publicly listed resource companies in the world, all competing for finite attention. And how do you, in this attention economy, how do you get eyes on what you have and what you do? I'd be a bit leery about that higher amount being spent on marketing. But at the end of the day, if that results in appetite for your shares go up, and then you have enough strategic and technical expertise, and you use that overinflated paper to acquire decent assets, that's a business model that you can get behind. But ultimately, if you've got fluff and nothing that there is a foundation to support that fluff, eventually your share price will retrace down to fair value. Now, that might take a year, it might take 2 years, and it's why sometimes technical people or people that have a technical background like myself, you can sit there and go, why is that company value where it is? That asset is terrible, it's never going to work, it's got fundamental technical flaws. But it doesn't matter, because 99.9% of the investing community isn't technical. They wouldn't know a good project if it smacked them in the head. So it's about how do you, I think, walking a fine line is how do you market yourself in a way to the widest group of people to encourage them to own your shares, to drive talk into your share price, to ideally create overvalued paper and then use that paper to build the foundation of your business. So let's see.
I mean, that strategy makes sense, Nicole, but isn't the danger that as soon as the marketing dollars stop, your share price is going to go down, you're not going to have that support? How sustainable is this strategy?
I don't think it is sustainable without reality. I think in a bull market is more sustainable than in a bear market. And I think so many people buy they buy stocks without doing any research. They don't do research on the people. They don't do research on the assets. They buy stocks because their mate said, oh, you should take a look at X, Y, Z. And so that's why you see this retail enthusiasm and this influence on the web forums and the chat forums. And you go and read some of these, whether it's Hot Copper or CEO.ca. I mean, it's absolutely fascinating just watching what retail investors think versus perhaps more of the reality of the situation. Yes, it's a house of cards. Yes, these things can be pyramid schemes, but you can make money out of that. I generally don't want to invest in those kind of companies because I prefer to invest in something that has got foundation and that is defendable. But I think it's then, how do you then build off that? It's buyer beware. Is it good for the business to have a bunch of promoters running around raising a lot of money at inflated values without anything to back that? Ultimately, no, because a lot of people lose a lot of money when the worm turns. So, but it can generate a lot of price performance in the short term. It's just you as an investor, it is incumbent upon you to understand what it is that you're buying and why you're buying it, and have an exit strategy.
Absolutely. And for any juniors out there that are looking for marketing opportunities, Kitco Mining and, of course, Digging Deep can be sponsored. That's all for this week. Nicole Adshead-Bell, thank you very much for joining me.
Thank you very much, Paul, for having me. Look forward to the next one.
And of course, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.